200 grand. Most people look at a number like $200,000 and they just see the ultimate destination. And let's be real, hitting this milestone, it's incredibly hard. It absolutely doesn't happen by accident. We're talking years of sacrifice, fierce discipline, and just immense patience. But here is the little secret that most folks never quite realize. That number right there, it is not the finish line.
Welcome to The Explainer. Today, we're diving into a massive, and I mean massive, paradigm shift. We're looking at exactly what happens after you hit that initial milestone. Because ask any wealthy family and they'll tell you the exact same thing. The absolute hardest money to earn is that first couple $100,000. But after that, the game changes. Entirely different mechanical wealth systems take over. So let's just dive right into this and explore the engines that activate after your early saving success.
Think of it this way. The first 200 grand is a launch pad. Period. Look, in the beginning, you're trading time for money, right? You're saving whatever you can. That is your income creating your initial wealth. But eventually, there comes a tipping point where your wealth actually needs to grow way faster than your own physical effort can manage. The absolutely crucial point here is this. While income creates wealth, it's the assets that actually build a lasting legacy.
So, to get there, here are the 5 distinct engines we're mapping out today: compounding reality, ownership, cash flow assets, time, and generational thinking. Plus, at the end, we're going to cover a pretty dangerous pitfall, which is the wealth sabotage trap.
All right, let's start with Engine 1, compounding reality.
This is the first and honestly, arguably the most powerful gear in your whole wealth machine. Because early on, investing feels painfully slow. But imagine 2 different investors. The first has 20 grand invested. The second has hit our launch pad of 200,000. Now, if the market returns a pretty standard 10% in a given year, the first investor gains about $2,000, which, hey, that's nice. But it's not really changing your life today. But our second investor? 10% of 200,000 is $20,000. That is an entire year's salary for a lot of people. And the crazy part, you didn't work a single extra hour for it. You didn't march into the boss's office to ask for a raise. You didn't even start a side hustle. This is the exact moment where your money actually begins producing more money than your own labor.
Now let's look at Engine 2, ownership.
Activating this engine requires a fundamental shift in how you look at your everyday transactions. You see, most people spend their entire lives strictly as consumers. They're always buying products. They stream movies, they order takeout, they upgrade their phones every single year. But the wealthy? They spend their lives owning the companies that sell those products. Think about it. Every single time someone taps a screen to order delivery, someone else is quietly collecting the profits. So the vital question you really have to ask yourself is, are you the customer or are you the owner? By investing in businesses, whether that's through stocks or index funds, you stop relying entirely on your paycheck and you actually start participating in the economic growth and innovation itself. It is a total game changer.
Which leads us perfectly into Engine 3, cash flow assets.
True financial momentum really kicks in when your assets start generating income completely independent of your daily schedule. We're talking about things like dividend-paying stocks, rental real estate, small businesses, royalties, digital assets, the whole shebang. Because the ultimate goal isn't just having some high net worth on a piece of paper. I mean, you can't exactly buy your groceries with unrealized capital gains, right? The real goal is creating a machine of assets that spits out income year after year. True financial freedom is achieved when these cash-flowing assets completely cover your living expenses. When that happens, your lifestyle is utterly decoupled from your working hours. Your money is literally working the night shift, the weekend shift, and the holiday shift, all for you.
Okay, Engine 4, time.
This is the wealth engine that nobody ever talks about enough. There's this huge myth out there that building wealth requires absolute genius. It doesn't. History consistently shows us that the most successful investors were simply the ones who stayed in the game longer than everybody else. Extreme patience wins. Time is the secret sauce that allows those dividends to compound. Time is what allows market downturns to actually recover. Look at it this way. Consumers focus on months. Investors focus on years. But legacy builders? They focus on generations. The earlier you begin, the more powerful this timeline becomes. And remember, unlike market returns or side hustles, time is literally the one single resource you cannot manufacture more of.
And that brings us to Engine 5, generational thinking.
This is where your mindset shifts completely. Wealth is actually highly fragile if it's not protected by education. Wealthy families eventually stop asking, how can I spend this money today? And they start asking, how can this money serve my family for decades? They focus intensely on financial literacy, education, and estate planning. Why? Because money handed over without any knowledge often evaporates within a single generation. It just vanishes. The greatest inheritance you can ever leave behind isn't just a giant pile of cash. It's the financial understanding of how to manage, protect, and grow that cash.
Now, let's slow down for a second and talk about the wealth sabotage trap.
This is a super crucial cautionary phase because it's where so many people hit a wall and completely stall out. Unfortunately, a lot of investors hit that $200,000 launch pad and they just kind of take their foot off the gas. Let's walk through this cascade of bad decisions. Step 1, they assume they've already made it, which naturally leads to step 2. They drastically increase their lifestyle spending. Suddenly, they need the nicer car, the bigger house. Step 3 follows right behind that. They stop investing aggressively because all their extra cash is tied up in those new expenses. And finally, step 4. They begin prioritizing outward status over accumulating quiet assets. You have to remember, wealth is a continuous mechanical system. It is not a final destination. If you turn off the engines, the momentum just dies. Every dollar invested today is multiple dollars tomorrow, but only if you actually avoid this trap.
Ultimately, the big picture here is generational legacy. It's about creating opportunities, value, and financial systems that outlive you. The end goal isn't simply dying rich. That's thinking too small. The goal is to build something far larger than a portfolio, far larger than just a paycheck. It's about building a system that continues creating immense value long after you're gone.
So, I want to turn this right back to you. What is your biggest financial goal for the next 10 years? Are you grinding to reach that $200,000 launch pad? Or are you ready to fire up the engines of a true generational legacy? Take a second, think about your very next step, and start building that system today.